Pakistan just wrapped up its first biannual review of the ongoing $7 billion IMF program. The discussions went smoothly, and the government is expecting to receive the next $1 billion tranche soon. But beyond the official statements, what does this review really mean for the economy? And where does Pakistan stand with the IMF moving forward? This review was part of the 37-month Extended Fund Facility, or EFF, which aims to stabilize Pakistan's economy. The IMF says significant progress has been made, but some key targets, especially tax revenue, have been missed. On the positive side, the government's efforts to reduce public debt, tighten monetary policy, and improve energy sector viability have been acknowledged. At the same time, discussions are also ongoing about a potential new arrangement under the IMF's Resilience and Sustainability Facility, focused on climate reform and disaster risk management. But here's where the IMF seems to have taken a more flexible stance. The tax collection target was revised down from 12.9 trillion rupees to 12.3 trillion rupees, and no new revenue measures were imposed, despite a shortfall in tax collection. This suggests that the IMF is willing to adjust its conditions if the economic slowdown is seen as beyond the government's control. However, the IMF did insist on certain structural changes. For example, the suggested grid levy on captive power plants will make domestic and imported gas supplies more expensive, aiming to prevent the power sector from collapsing under financial strain. The distributed rooftop solar policy has also been revised to reduce its financial burden on the national grid. So where does Pakistan's economy stand today? Inflation has slowed, the current account is running on a small surplus of $700 million, remittances are projected to reach $35 billion, and foreign exchange reserves are gradually increasing. But the economy is not in the clear yet. Large-scale manufacturing has declined, tax targets are being missed, and external pressures are growing. In January, the current account slipped back into deficit after a few months of surplus. Weak financial inflows and ongoing debt repayments have also put pressure on foreign reserves. On the global front, rising trade tensions, especially the US import restrictions on China, are creating uncertainty. The State Bank of Pakistan has warned that this could impact global trade and commodity prices, influencing Pakistan's economy as well. Meanwhile, domestic politics are adding to the challenges. Facing pressure from the opposition parties and economic constraints, the government is under pressure to accelerate growth. But how they choose to do it will be crucial. Some policymakers are pushing for tax incentives in real estate, a move that has historically led to balance of payment crises. Many in the government recognize the risks, but real estate lobbies remain influential. A similar move under Imran Khan's administration in 2020 led to tax amnesties for property investment, which later contributed to economic instability. Will history repeat itself?
We have seen the economy stabilize under the IMF program. Slowly, but steadily, it is stabilizing. The volatility in the markets, in exchange rate markets, in stock market, that has addressed. Then the government is forced to carry out some implement some fiscal stabilization measures. It is trying to increase taxes as well as reduce its expenditure. So overall, if we look at the economy or major economic indicators, I think that we have come a long way from the edge of default in 2022. And I think we also have built up our foreign exchange reserves. So, good things apart, but still we have a long way to go. The external pressure, we have seen that external pressure is under pressure because external account is under pressure because of because imports are rising, but mainly because we are not getting any foreign direct investment, private investment. And then we are not receiving any funds from our, from our friendly countries or whatever you call. Until 2013-14, we used to have this credit lines from multilaterals as well as bilaterals. So we could depend on them for our import bills, for our debt repayments, etc., etc. But in the recent years, we have seen that this this channel has almost dried up. I mean, apart from some safe deposit kept with the State Bank by China, Saudi Arabia, and UAE, no bilateral, I mean, partner of Pakistan is giving us money. So that is a big problem. So this has created I mean, very big hole in the financial account of the State Bank. So that means, and for last few months or years, a couple of years, I think the financial account is in the negative. What does that mean? That means that we are our FDI, the amount of FDI we used to receive has is declining, as well as the official loans from bilaterals or multilaterals are declining. So we have to negative financial account means we have to uh, pay for our account, pay for our debt repayments from the current account. So these remittances, the increase in remittances, which I mean rose by like 33%, almost 33% in first 7 8 months. So these have been the saving grace. I mean, these have compensated the uh, declining official and private inflows. So I think two or three major issues remain. Number one, of course, relates to the taxation. I mean, we have seen our tax collection increase significantly, but we also see that the increase is coming from the same old taxpayer or documented economy segments. We haven't actually been able to broaden the tax base. So this is not sustainable, I think. At some time, I mean, we have seen that the big industry output is decreasing, and heavy taxation on the industry is one of the reasons for that. Secondly, of course, I mean, the major issue that our economy is facing is the dollar liquidity crunch. I mean, we have seen that the little pressure from imports in December and January, and we saw that uh, uh, that pressure creating, leading to reduction in the foreign exchange reserves of the state bank. So this is a big worry. I mean, unless we have a smooth inflow, I mean, not just remittances, but from private foreign investment and from official funding from multilateral agencies or bilateral lenders. So that will remain a big worry for the policymakers. And because of these and third, of course, I mean, we haven't done anything in the recent. I mean, our policymakers have been our ruling party people. They have been talking about structural reforms and business friendly policies, and they also, I mean, created that this SIFC for removing the hurdles that investors face, especially foreign investors face in bringing their capital to Pakistan. But what happens that we haven't seen any actual reforms to address the structural issues that are impeding investment. I mean, our power rates are very high compared to other regional competitors and or other economies. Our taxation rates are very high. Then, of course, our interest rates are high at the moment, and we cannot bring them down, even if we want to. So, I mean, so we have to look at these three main things if we want to grow the economy. Number one, foreign. We have to somehow take measures to attract foreign direct investment. We have to, increase our exports to increase, and before that, we have to increase our productivity. Because we cannot just depend on textiles for uh, uh, for our export revenues. So, and then we have to broaden our tax base to lessen the burden on the organized sectors and salaried classes. And then, of course, we have to implement policies that are for every investor, whether it is local investor, whether it is foreign investor, whether it is some foreign government or whatever. So we have to give them equal access to, opportunities, investment opportunities here. So these are the areas where the government needs to work.
As Pakistan navigates IMF conditions, economic pressures, and political realities, the choices made in the coming months will define the country's financial future. What do you think? Should Pakistan focus on real estate-driven growth, or is it time for deeper structural reforms? Let us know in the comments, and don't forget to subscribe for more in-depth analysis.